So one of the things that when we refer to loan assumption, we are talking about what the assuming the old debt brings to the table. And when you're underwriting your deals, you have to take into consideration. So like we mentioned, we had several calls with potential investors, potential partners on looking at some deals. And sadly enough, they use the blanket statement, and maybe it's because of the brokers, guiding them in that direction. That a loan assumption as a blanket statement as a good deal is going to make your deal great. But there are some questions that you should be asking when you're assuming the loan. And the other thing that I was going to just kind of give you information on, when a seller is buying a deal that is letting you assume the debt, you're going to assume all the terms that come with the established or the debts in place. And that's going to save a lot of processes, a lot of application fees, a lot of time, because you don't have to get a new loan. If you have closed on a larger syndication, you know that that's one of the most, I'll say, lengthy procedures that we do, that we have to go to apply for a loan. I'm trying to recall how much is the application. I know we start $50,000 just to start the application process. So there's a lot of fees associated with the process of a new loan. So when we see a loan assumption possibility, immediately we want to explore that as an option, but we have to be careful on what comes with it. So based on that, we want to shine some light on that aspect and under the underwriting especially. And
another good potential for a buyer with a loan assumption is that you can get a cheaper final sales price, because if there's a large prepayment penalty on a loan, the seller is going to include that prepayment penalty as part of their selling price or some variation thereof. They're going to try to get as much money as they can to be able to pay off that loan and pay off that prepayment penalty, as well as to give back to their investors. So if you do a loan assumption and they don't have that prepayment penalty, oftentimes you'll see that you're able to buy that property at a lower price. It would just kind of depend on how their loan documents are written and what the prepayment penalty might be.
So I will say, when you're presented with a deal that has the possibility for a loan assumption, they're going to send a term sheet that has the information on the current debt. The important thing is that you are able to understand what that means for your deal and how is that going to affect not only the purchase price, but also the performance later on. Because if you have to pay the fees associated with it later on, the interest that is on, then that's going to kill your cash flow, not only at the beginning, but at the beginning it might sound appealing, but then towards the end when you have to come up with that money.
Two reasons why we're talking about this today. One is that over the weekend we had somebody talk to us about a deal they thought was a good deal, and they mentioned the fact that it was a loan assumption, and I immediately went into a small spiel of asking questions for information, and they didn't have that information readily handy. But what they did was, while we were having another conversation, they pulled up the loan documents. And this is something that you want to make sure you have access to before you go under contract. It's okay to do your LOI with terms that they told you, but you definitely want to make sure you see your loan documentation and you go through it with a fine-tooth comb to make sure that you know all the ins and outs of that loan. Anyways, they brought up the loan documents, and I'm scrolling through these pages, and I want to say it was like a 75-page loan document. And I'm looking through and I'm like, okay. Sure, okay. And things that I was looking at. Now, I wanted to know when the loan term started. So I wanted to know the start date on the loan and if there was an initial interest-only period. So period where you only had to pay interest on the loan. You didn't have to pay off any of the balance or any of the principal. And how long that period was. In this particular loan case, I was also looking to see when the loan comes due. So the start date, the final term date. So this was a 240-month loan term, which anybody who can do quick math on the fly, that is 20 years. And so it was a 20-year note. The first 5 years were interest only. And then after that, you had to start paying principal payments. Not a terrible thing on its own when you think about it all on its own. However, when it came out of its interest-only period, which was only about a year left on it, the interest-only period was fixed rate at 3.69, which is a great rate right now. Right. Everybody would be excited to have that. But when it came out of the interest-only period, it converted to a variable rate with a spread. I don't remember whether it was based off of LIBOR or SOFR, but in the overall that was all I needed to see, was that it was now now it was going to turn into a variable rate, and it was going to be based off of today's market. So this loan suddenly went from being an amazing little unicorn to something very different that would take a few minutes to try to calculate. But in the end, you only really got benefit from the first year. Everything else would have been a little harder to justify, I guess, at staying with this loan.
So one of the appealing factors of assuming death is that we're going to assume something that is a lower rate than what we can assure get current rates, right? But if this loan expires or fades out, the interest only, which is, I call it the honeymoon, it goes away within a year, then you better start planning for a variable debt, which is what we are running away from right now, right? So being able to interpret what that means when you're looking at those documents, you should be able to make the decision. In this case, even if we were to use new debt, it's actually better than to go in a floating rate if we're going to go on the second year, right? Since it's going to convert into a floating rate. So you have to be extra careful. And if you're not comfortable looking at those term sheets, you reach out to somebody, reach out to us, let somebody take a look and make sure that you understand how long is it that you're going to have a good permanent debt.
And one of the questions that I would make with that loan would be, if I highly doubt that this would have occurred, but would they or did they get a rate cap for their variable loan portion? Now, I don't even know if that's possible to buy one, 5 years in advance, but that could be a contingency for you to assume that loan, is that the seller would be willing to absorb that cost to purchase, and that could help protect you. If that's even a possibility, you would have to talk with your lender at that point to verify, but it's just another thing to think about. So at the moment, we were able to see when the loan started, when the interest only period ended, how long was the actual full term of the loan, and the fact that we determined that the interest rate was changing from fixed rate to variable, and that you would now also have to pay a principal payment on top of that variable rate. So I believe Shan put in the chat that it was a LIBOR plus 325. So that interest rate would have, whatever LIBOR is or what will be at that time, it's only going to be a half a point from LIBOR is what the original fixed rate was, because the original fixed rate was like a 3.69. So with that spread, it already covers that 3.69 almost. And so that could make it a very dangerous zone that you're in. But the extra kicker was that this loan required yield maintenance for its prepayment penalty. And
what is yield maintenance, Chris?
Oh, I was just about to go there. I was going to say, so there's a couple of different things about your prepayment penalties, and that is, when does it stop? When is there no longer a penalty for you to pay this loan off early? Oftentimes it's within about 6 months of the end of the loan, and there's different types of prepayment penalties that are potentially available. But in this case, like I said, yield maintenance, and that is, I'm going to say that it is calculated off of the number of years of loan that are left or number of months left to pay. Also calculated with interest rates that are currently accruing. There's a calculation that they do to determine basically the amount of interest that they would have received had this loan gone to the end of the prepayment penalty period. And then the seller or the person paying off this loan would be responsible for paying that amount on top of whatever the principal balance is. So think about this. We said earlier that the loan term was a full 20 years, and they've only gone into it for 4 years at the moment. So you would owe interest for the next 16 years when that loan gets paid off. That would be the prepayment penalty. 16 years worth of interest paid at once. So this is where I was saying earlier that the sales price would have been higher if you did new debt, because they're going to absorb that cost. The seller's not going to take on the entire cost themselves. They're going to make the buyer try to absorb some of that as well. So this, again, if this was going to be a long-term hold greater than 10 years or so, maybe it would make sense, and maybe you would be able to find somebody else to assume the loan, but you can't count on that, and you have to do what's best for the deal for you. And if it's step away, so you step away. If it's assume the loan, then great. If it's get a new loan, that's fine too. You just have to remember you might end up with a higher final purchase price that you would have to capitalize for. Now, the other versions of prepayment penalties are a step down. So, and oftentimes you'll see this with a bridge loan or maybe a 7-year full rate, where years 1 and 2, it might be locked out. and then they do like a 5, 4, 3, 2, 1 step down, and that would be the percent of due the percent of payment penalty due based on the principal that was left. So in year 3, you would have to pay a 5% prepayment penalty, but in year 6 into the end, you would only owe a 1% prepayment penalty of the loan balance that was. Jeremy asked, what institutional banks are you all using? So I will say that we've processed with the Bank Corp is one of the banks that we've processed 2 of our loans with. I want to say Newmark is the broker. I'm not 100% positive of the bank that we had used on the previous. I just don't remember it, but it was a Fannie loan. That's the part I remember, and I just don't know which company he was with.
I'm trying to remember.
But I believe he was just a broker, not the lender itself.
Yeah, but if you're able to unmute yourself, if you want to join the conversation, you say you're having a hard time finding lender partners, let us know. Send us an email or a text, because we can connect with, we have some good relationship with lenders. So we would love to help you if that's what you need. So yeah, we were talking about the supplemental.
Can I ask a question? I'm sorry.
Absolutely.
Of course.
Anytime.
Hey, Chris and Stella, sorry. Hi, how are you? One is this common Freddie loans like this? I mean, do they all have prepaid penalties? It's very common.
Say that again.
Is it common to have prepaid penalties with the Freddie loans?
Absolutely. It's common with all types of loans to have some sort of a prepayment penalty or maybe even a lockout period. A lockout period is where you cannot refinance or pay off the loan during a certain portion of the initial portion of the loan period. And then prepayment penalties will usually last up until, I'll say, the last 6 months of most loans, not to include the extension periods. So if you got a 3-year loan, you got a 5-year total with 311 is what it would be called with a bridge. Then you'd have 2.5 years with prepayment penalties, 6 months where it would be open. And then if you buy at the extension period, it will usually cost you 0.5% to a full percent. Again, read your documentation so you know those answers correctly. Don't go based off of what somebody tells you. Make sure you read your documentation. Some people are under the belief, or were under the belief, that at the end of the 3-year period, they would just pay their 0.5% or their 1%, and they would automatically be able to get their extensions. Well, with interest rates rising as they have, there are many projects that they do not meet the DCSR, which is the debt service ratio that is required by the lender. By the end of year 3, they need to meet a certain ratio, and this involves the lending, mortgage payment, and such on top of what your NOI is. So if you're not able to cover that, then they will not allow you to extend your loan because you have a higher build rate and DCSR that you have a requirement for. Hope that helps.
Gotcha. Yes, it does. It does. Secondly, now the interest rate is already 8.5. Are you talking about the agency loans now? The interest rate is 8.5 now?
So interest rates, I will say last week, the word that we had was the agency loans were in the 5.5 to 7.5 range. It all depends on the time frame that you're looking for, how much you're putting down. There's different variables for that. So the less you put down, the higher the interest rate was. We actually closed on a deal at the end of November where we had just under a 6% interest rate, and it was agency.
Permanent debt. And I will try to explain just briefly and why the early or penalty for early exit on the permanent debt. So if you think about it, a bridge lending versus permanent debt, I think of it as a person, right? And we do private lending, so maybe that's why I can relate to it. Let's suppose that I'm doing lending for bridge, right? So my money is expected to go for a short amount of time usually, and usually we have higher interest rates, right? But it's going to come back quickly, and I'm going to be able to turn around and lend it again and make more money that way, right? So when you think about...
And the bridge lender usually has less overall requirements for you to meet in order to obtain that bridge lending.
Yeah.
And that's part of why they carry a higher interest rate.
Yeah, think about it as the private lending, the short term. So when you compare that to permanent, which is Freddie and Fannie or agency, right? That's another name that you'll hear, agency. Those institutions, they don't want to be flipping money, right? They have an expected amount of profit that they're going to make for their investors. So they want to look for assets that are going to be long and stable. And because of that, if you have to exit early for whatever reason, they're going to still make that money. So that's why they have all these penalties and all these payments, yield maintenance and deficiencies that they have to add, because they still have to make the money to their investors. So think about permanent or agency loans as those that are kind of elderly. They don't want to move things around. They just want a steady income over 30 years, right? So that's what they pay differently to their investors, right? So that's why they have all these associated fees to exit, because they make it really difficult to enter. They're very particular on their underwriting, and your deal has to meet the certain income that these sets are. So it has all the expectations that your deal is going to perform, right? And that's why they're very, very careful, because they want their money to be in a lower risk, more permanent, long term. If you want to get out of that, it's going to cost you a lot of money, and that they still want to make the money. I hope that helped you understand.
It does. It makes sense. Thank you.
Sure. No problem. Thanks for the question. Any other questions? So Jeremy
said he was quoted 8 today, 8% interest on a bridge, on or agency, long term, short term. Just out of curiosity, Jeremy, and maybe a dollar amount for the principal, just out of curiosity, so people have a reference point.
Awesome. Thanks for that info. Yeah, that's what we quote. And remember, our lender always tells you whatever I quote you, underwrite with a 0.5 increase. So
and right now that's only because the market's so volatile and everything, and things are changing so fast. They want you to be on the safe side. If the deal works when you're adding in higher than the current, there's less likelihood that you're going to need to retrade that deal should rates change again. That was actually something that he said this weekend as well.
Yeah, and retrading, it sounds popular, but it really is not. And at this point, this business, real estate, is about relationships. So if you're going to turn around and retrade a deal, it needs to be for something that is valid, and otherwise you don't want to create a reputation that you're trying to. It's not like going to Mexico when you're bargaining for your souvenirs. Blended rate. If you're assuming a portion of the whole loan, and then you still need a supplemental, then the lender will combine you both interest rates, and then they'll give you what's called a blended rate. So we've seen that, and again, we're trying to bring this conversation back to past investment, right? When you're presented with a deal, these are the new terminology that you'll see and some of the questions that you should be asking. So to make sure that you're making the right decision or on your investment, or that you're comparing the investments properly. And if you're the one offering the opportunity for investment, to be prepared to answer all these questions, because you're going to be asked, I hope, because we are here to educate our investors. And anyone in this room is investing in your deal, they better be asking these questions.
Step down as a prepayment penalty. Again, it usually ends about 6 months before the end of the loan term. And that's kind of the sweet spot for selling a property, where you don't have any prepayment penalty and the loan is not overdue. So that's really the spot. That's why when you're looking to purchase a property or an asset, you really do want to think about, what is my exit strategy? When do I think I'm going to meet that requirement? And of what the expectation is for the investment opportunity. And once you have those ideas in mind, then you go out and find the correct size debt. Now, with a market that's volatile, maybe the perfect debt time frame is not the perfect debt cost-wise for you. Maybe it doesn't help you meet your business plan in the right way. And so maybe you leverage it for a little bit longer with the expectation to provide it as an assumption. Maybe down the road you think that interest rates will stay up, or they'll stay higher than whatever your current rate is, and you could get away with an assumption with maybe 2 years on it. And then that gives the new people, the buyer, the opportunity to implement their business plan, and they should be at a point where they're ready to refinance or do a supplemental loan. In this case, it would be a refinance, because that loan term would be coming to an end, but the principal would still be there for them to pay off like a balloon payment. And so we would like to refinance at that point. But you have to make sure that there's enough life left in that loan to either help them get through their business plan, or at least through the point where they can stabilize the property and make it worth a refinance. The alternative is that they go get new financing and pay off the debt, to include helping you with your prepayment penalties.
For what reasons would a lender pull out of the loan on you on the day of closing? That's called leaving you at the altar?
That's a really good question. There can be a lot of different reasons, one of which is the market volatility. Maybe they can't find the funds to be able to fulfill the requirement for you on closing day. Maybe their lending dries up. Maybe the interest rates have changed to a point that they can't project 3 years out for your deal and see that you meet the DSCR, the debt service credit ratio or coverage ratio. We talked about that a few minutes ago, and that number is usually, again, read your documentation for this, but usually it's either a 1.0, so your income after all the bills are paid, your NOI basically equal to whatever your loan payment, your debt service is for the year, or it could also be oftentimes you'll see a 1.25 debt service coverage ratio that's required, which means that you make 25% more than whatever the debt service is. That gives a little buffer in case there's something going on. With the market the way that it has been recently, there's also been a change in the loan to cost, that the proceeds that they may have told you 2 months ago may not be the same amount of proceeds that they can give you today. So if you were to buy something for $23 million and they said, we'll give you $14 million for loan proceeds, and then the market shifts and they say, sorry, because interest rates went up, the income for the property, all the numbers for the property don't change except for that interest rate, it means your expenses just went up on the post below the line, is what we call it, below the NOI. Your interest payment has gone up. It has increased. And now your deal no longer meets the DSCR. And so they're going to decrease their loan proceeds until it looks like it will meet the requirement. And so instead of getting $14 million, maybe they're only able to give you $11 million. And if on the day of closing, you're unable to fill that gap, that $3 million gap or whatever it might be, it could be $200,000 gap, and it won't matter. They will not give you the money to fulfill the requirement to buy that property. And so that's one scenario in which they could walk away. The other is that, like I said, the people where they're getting their funding from for your loan may have decided that they changed their criteria. They're no longer interested in multifamily, and they're going to go a different direction. And so they can back out in that direction. This is where it's really important to have strong relationships with your brokers, because those are the types of lenders that these brokers will generally steer away from, are the ones that have a habit or maybe they have a history of backing away from deals. There are other ones that, with the market the way it is, their priorities and calls have just changed, and it just happened to be around the same time that you were trying to close. Usually they try to give you a little bit of a grace period, try to tell you like a week or two in advance if they're going to do something like that, and they'll do what's called a retrade and go to a different lender for you and get things to continue on. But oftentimes when it's that close to closing, you just have to go back to the seller and ask for an extension, explain the process and what's going on. In this kind of a market, they are fairly receptive because they don't want to start the whole process over and go another 60 days, 90 days, where with you, it could be 2 to 3 to 4 weeks. And so they sell this property a little quicker at the same price that it was under contract for.
Jenna has a question here. What are the benefits to the seller? Are they paying any taxes or etc.? Good question.
So with an assumption, the benefits to the seller are that there's less cost involved because they don't have that prepayment penalty.
Yeah.
They are also receiving a lower price point. So I would say, yes, there's less taxes involved for the sale. And there was one more.
So they can also, it makes their deal more appealable to buyers, because especially right now, if they can offer lock rate that they secured years ago and they can pass that on, that helps us as buyers, right? So as seller, their deal looks stronger if I see one with an assumption that it meets the underwriting criteria and it's beneficial for us. I'll be all over it. I'll be all over that loan assumption, right? So if I have to pick one that lets me assume the debt compared to some that don't, then I'm probably gonna go pursue the one that has the loan assumption, depending on being able to make it work with the underwriting and the terms.
I have a quick question, Chris, if you don't mind.
No, go ahead, Jen.
Remember we talked about this deal still have about, let's say, 2 years left, but really it doesn't make difference if they still have, let's say, 4 years left, right? Because the pre-penalty is still there. So
on that
you
particular
have
loan,
a little bit of longer term, really, a longer period to refinance, right?
Right, on that loan document that you showed us, that was a 20-year loan. It wasn't amortized for 20 years. It was an actual loan for 20 years. You're correct that it would not have made a difference on that loan. But some loans, it might be only a 7-year loan, and maybe you're trying to sell it at year 3, 4, or 5. And so it would give them just enough time to implement their business plan. They could be taking a risk if they tried under 3 years on the loan assumption. But if they were strong performers, then they could always take that opportunity to capitalize on the lower price. Because that lower price point really does make a difference at different times, because of the amount of lending that would be required, the amount of capital to raise, even for your equity. That was part of what we were talking about earlier with that loan to value change. If they can stick with only the one loan and not have to get a supplemental to close then that could be what makes the most sense.
So, Sean, thank you for that question. And so we didn't mean to pick on you. That was one of the last loan assumptions propositions that we saw. But since you mentioned that you're here, because I remember when you first brought the deal, you mentioned that the broker presented the deal to you as that this is an excellent assumption, right? And this sounds so appealing. So if you are willing to share, were you presented with this deal and what you thought about it before you talked to us, with the information that you had, how do you thought that this could be a deal that you can take under your belt? And now, knowing, I would say, the danger of assuming that, would you still pursue that deal? If you don't mind, if it's okay if you don't have to answer.
No, that's okay. Not at all, really. When I talked to the loan broker, he mentioned, about the floating term, which will be in 2 years, less, 23 months, then you can just always refinance. And also because that's a Freddie loan, when you refinance with them, they will reduce lots of fee. That's his appealing point. He said only 1%. The rest of lots of in general, they will have lots of fees. That appealed to me. And definitely assumption, I had not looked at the detail of the loan, those terms, because everything, I have no calculus square footage really. Kind of in the average market range. So I want to look at it properly, like everything. That was the reason. But after I showed you guys the loan documents, and Chris pointed out the pre-penalty, so that made me think it twice. To be honest to you, I'm going to do my own underwriting, everything, and then we go from there. But the best way I would say it's depend on your strategy. If this is a long term, like you guys mentioned, if this is a long term holding, let's say a couple or several people just want to hold a long term, then maybe that's a good exit strategy to hold this property like this. Otherwise, just like you said, most of you syndicate the deals and you want to perform 3 to 5 holding period. Probably not a good, in general, not a good idea for these type of properties. I totally agree. But thank you very much for sharing this information with me, for your advice. I really appreciate it, both of you, really.
Not a problem at all. And you're not wrong.
Yeah.
When you refinance, if you use the same lender, you are correct. Sometimes they will waive their prepayment penalties. I would definitely, so for us, I would want something in writing from the lender that were the case before we assume this loan, that they are willing to refinance with waiving all fees. I would want that in writing before we went to the closing table, just to substantiate and feel better about the process moving into it. Because if it's not in writing, then they don't have to abide by it. And I would not want to take that chance with investor money that we think that it's going to work, but we don't know for sure. So excellent. Thank you very much. We appreciate you sharing. And that does make more sense as to why you would think that it was a good deal if they're willing to waive those fees.
So are you guys starting to see more sellers starting to come around to the reality of the market, or are they still trying to hang on their asking price points from 9 to 10 months ago? Excellent question. Go ahead. I think that we have seen sellers being more realistic on their price. In fact, the one we closed last week, 168 units, it was put on the market back in February, went under track around March, and then fell through. So when we bought it, it wasn't a renegotiation. It was actually a discounted price, which it looks better for all parties, right?
And the team that purchased it did not have it under contract the first time.
Mm-mm.
They picked it up based off of a relationship with the seller. It was an easier pickup that way, I guess I'll say.
But I think that this is what we got from some of the lenders that were in the conference, that they are starting to see it's better to just go with a realistic number and close instead of still holding it to a higher price, because what has happening, they might put it on the right, everything goes well, LOI is accepted, but then when it comes to the lending, it's when the deal falls through. And that's exactly what happened to the other one that we purchased. So putting it under contract and getting an accepted LOI with a good price is not a problem, but the lending is going to reject. So if you can get lending, of course you can close, right? So that's what the lenders were talking about, that I think there's communication in which they are giving the feedback to the sellers, when they first get an assessment of value, right?
And I will say that it kind of hits almost all the other questions that happened tonight too. So we were mentioning that it went under contract. They probably did their LOI late February, and when loans were coming in at 75%-ish, depending on the market. And by the time May and June came around, they were only doing like 68% or 65% loans. And so you had that large change right before what would have been close to the closing, like Gustavo asked, why would a lender leave? Well, the market changed, so their loan to value changed or loan to cost changed, and they weren't able to provide the extra equity that was required. So they had to drop out of the contract, or were unable to fulfill the contract. So part two to his questions was, are you guys submitting any LOIs or hanging tight until Q1? Well, a good deal is a good deal regardless of when you buy it. So we are currently underwriting things, and we'll say that we have a LOI accepted and far enough that it's gone to PSA.
Yeah,
so
we're under track on that one.
We'll see what's going on. It will not close this year. Things moved along a little too late in the year for us to be able to close it this year, but we're pushing forward, and hopefully by the end of January we'll have 92 doors under our belts.
Yep, and we're submitting LOIs. We're continuing on the writing, submitting LOIs as we speak. So we haven't take the pedal off the gas. Yeah, definitely no hanging. So Paul, does the LOI for an assumable loan have to have a significantly different language than the one with an agency or bridge loan? That's a good question.
So just remember that your LOI is the basic terms of your PSA. It doesn't lock you into anything 100%, but you can put that the expectation is to assume the loan as opposed to new debt, and they will understand they'll understand where that goes. One of the things about assuming debt that I don't know that I mentioned earlier is that when those loans were doing 75% loan, that principal balance is still there. So unless the property is now selling for something that makes the balance only, we'll say 55, 60%, it all depends on what your loan to value is. If your loan to value with the assumable loan is at 65% and that maxes out your loan proceeds, you're not going to be able to get a supplemental or an additional loan to cover the rest of the proceeds. You'll have to raise that equity. Mm-hmm. Now, if the principal balance is only 40% of the value of the property that you're buying, then you could get a supplemental to cover the rest up to whatever the max loan value is. So 65% might be your number. And so you can get 20% as a supplemental. Then you end up with that blended rate. And you can lay all of that out there for them in your eye. But the key portions would be that it would say something along the lines of assuming the current debt, and then if you think you're going to get a supplemental loan and you've got approval for that from your lender, then you could put in that you're planning to get other debt. To crisscross to Danny's question, a lot of people feel like it's a buyer's market, and it is to an extent, but the seller still has some reasonable control. They're not all like coming up on the very end of their debt or the very end of their stuff yet. Still a couple months off, and so they're not necessarily as eager to accept an offer that has a loan contingency. So if you're not certain about new debt, you don't know for sure that you're going to be able to get it, or you're worried about those loan proceeds changing last minute, it still is portion that's your problem to deal with and be prepared for.
I would say the loan assumption has nothing to do with the loan to value. So the there's going to be a high risk that you can put in the property or in the asset. And that's, obviously defined by the lender. So if you have to, get a supplemental, it has to be supported by the DSCR at the end of the day. Guys, thank you so much for being here.